Actually, if you look back, and I mean, you can look, going back to the 1980 episode, just go look back, and you'll see that the reality is because silver is such a small market, that sentiment and flows affect silver far greater than gold. And I guess the easiest way to explain that is in a bull market, silver goes up faster than gold, and in a bear market, silver goes down faster than gold. So in my mind, the reality is that once there's a trend that has begun, silver leads, gold does not.
Analysts at StoneX Financial are also bullish on silver. In their 2025 annual metals outlook, they picked silver to outperform all precious and base metals. The silver price chart for the last 5 years reveals that silver has outpaced gold in terms of percentage gains, fueled by rising demand and supply constraints. Furthermore, over the last 20 years, both metals have shown strong price movements, often influenced by economic downturns, inflation, and global crises. In this video, BillHolter, ex-retail stockbroker and precious metals expert, discusses how the precious metals market is already tight and is looking to get tighter. Holter emphasizes that while gold remains important, silver is the real story. Unlike the usual pattern, he suggests silver could take the lead this time, citing historical trends where silver moves more aggressively. According to the history of silver prices, silver saw massive gains during the 2011 bull run, hitting record highs before being corrected in the following years. While reflecting on ongoing trends, Holter underscores the growing tightening in the physical gold market, pointing to significant metal shipments from the London Bullion Market Association and limited deliveries on the COMEX. He notes that retail demand for precious metals in the U.S. has declined, with many investors selling gold and silver to cover financial hardships. While the gold market has seen significant flows from London into New York vaults, the London Bullion Market Association said it still has plenty of the precious metal to fulfill over-the-counter investment demand. On Friday, the LBMA published updated vault holdings, stating that London vaults held 8,535 tons of gold as of the end of January, a 1.77% decrease from December. The gold held in London was valued at $771.6 billion, which equates to approximately 682,772 gold bars. Regarding silver, Holter mentions how exchange for physical transactions obscures true deliveries, raising doubts about whether metal actually changes hands. Now, we present the clips of BillHolter's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
There is a physical gold market tightening already in place. And I mean, you're just seeing that on COMEX, you're seeing it because LBMA is having to ship metal. I mean, 400 tons, that's a lot. That's more than what COMEX delivers probably in a year's time. So there's already tightening from the standpoint of big money. I can tell you the retail demand in the United States has definitely slacked off, and we're now seeing a huge amount of sellers. And I think that's a function of the real economy has been much softer than has been reported. People have eaten into their savings, and they're liquidating gold, they're liquidating silver to survive. I think the real story, when all is said and done, is not going to be gold, but I think it's going to be silver. And I think the March delivery month is already starting to shape up where there could be huge delivery demand and potentially a failure to deliver. And I've said all along, I thought that the fuse would be silver. And once that went off, then gold would immediately go off. So I don't think there's going to be, I do believe that the deliveries will be done for February gold on the COMEX, but I think the real problem is March silver. Actually, if you look back, and I mean, you can look, going back to the 1980 episode, just go look back, and you'll see that the reality is because silver is such a small market, that sentiment and flows affect silver far greater than gold. And I guess the easiest way to explain that is in a bull market, silver goes up faster than gold, and in a bear market, silver goes down faster than gold. So in my mind, the reality is that once there's a trend that has begun, silver leads, gold does not. I mean, if you look at look at the COMEX numbers. The amount of open interest for March has been increasing, not decreasing. And normally, by now you would already see it starting to decrease. And, we saw this back in the middle teens, late teens, where the open interest would increase, and then going, say, a week to 10 days before the final date, you would see a collapse in open interest. And we couldn't figure out for, I don't know, 2, 3, 4 years as to how that was being done. And the way it was being done was those contracts were being laid off onto EFPs, exchange for physical. And those exchange for physical contracts were based out of London. So theoretically, the deliveries were being made out of London, not out of New York. And I guess, I get one way to look at it was, that saved shipping the metal overseas to COMEX to deliver. But the other thing is the EFPs are, you really can't see behind the scenes. So you don't really know if the metal actually got delivered or didn't get delivered. Or, there were rumors at the time that the EFPs were paying off 20-25% premiums in fiat for the owner of the contract to walk away and say, now we'll take the fiat, we won't take delivery. So, that very well could have been a way to relieve some of the pressure.
BillHolter predicts the next major move in interest rates will be up, not down, due to a lack of risk premiums in global debt markets. Holter also highlights global debt exceeding 300% of GDP, arguing that lenders will demand higher interest rates to compensate for risk. He suggests that if the Fed lowers rates under political pressure, it would confirm its lack of independence. The most recent projections from the Congressional Budget Office confirm that America's fiscal outlook is unsustainable, increasingly driven by higher interest costs. In addition to the rise in interest rates over the past couple of years, growing debt has significantly increased the cost of federal borrowing. In 2024, interest costs on the national debt totaled $881 billion, surpassing most other components of the federal budget. Over the next decade, the U.S. government's interest payments on the national debt are now projected to total $13.8 trillion, the highest dollar amount for interest in any historical 10-year period, and nearly double the total spent over the past 2 decades after adjusting for inflation. In terms of inflation, Holter describes a split economy, raising prices for necessities but deflation in assets like commercial real estate. Additionally, he warns that a sudden equity market crash could trigger widespread financial turmoil, especially in the derivatives market. Let's get back to the interview.
Let's say that the Fed does continue to cut rates. At some point in time, foreigners are going to look at it and say, hey, wait a minute, I can get, I'm not sure if this is correct or not, I think it is, I can get 4.5% on a German bond. Why would I accept 3% or 2% or whatever on an American bond? And what that's going to do is it'll weaken the dollar, and it'll make it harder for the U.S. to borrow and fund the 1 trillion, 2 trillion, whatever the deficit happens to be. Those deficits are going to be harder to fund without higher rates. So, I've been asked this for the last probably 6 months, and it's my guess is the next huge move in interest rates is going to be up and not down. And it's going to be up because at this point, there's zero risk premium. If you look across the world, there's no risk premium. There's some countries like Greece that pay less in interest than the U.S. And yet there's other countries, for example, I believe Russia pays, if they had to go out and borrow in the Forex markets, if they borrowed, they would certainly pay more than what the U.S. is paying. But Russia's 17% debt to GDP, and we're 130% debt to GDP. Which one has more risk? So what I'm getting at is I think we're going to see higher interest rates based on a real risk premium being placed on the different debt securities worldwide. It'll play out like a comedy/tragedy because, you've got Trump. The guy's a real estate guy. The guy wants, he wants to borrow money and pay nothing. Who wouldn't? It just, if you could borrow money for free, why wouldn't you do it? That's the comedy part of it. The tragedy, I think, is that, the first thing that's going to go by the wayside is if the Fed were to acquiesce and lower rates like Trump wants, then that's proof that the Fed is not and never has been truly an independent entity. And one other thing, I think the whole yield curve worldwide is going to go higher, and that's just based on the simple math that the world collectively is now, if you look at the total amount of debt outstanding, it's over 300% of debt to GDP. So the entire world is awash in debt. And I think, the way to and I don't want to use the word mitigate, but the way to compensate for that is that the lender gets a higher interest rate and the borrower has to pay a higher interest rate. I think what we're seeing is inflation of the things we need and deflation of the things we have. You look at I just said, the commercial real estate market. Those commercial properties are down, 40, 50, 70% from where they were just 5 years ago. So you're already starting to see deflation in that market. You're already starting to see stagnation in housing prices in many places. Look at Florida. Florida has stagnated, and you're seeing pockets in Florida. You're even seeing pockets. I live, an hour or more outside of Austin, but Austin has stagnated. So you're seeing a lot of these hot markets cool down, and you're seeing some price drops. You're seeing more supply come onto the market. So you're starting to see deflation. And all it would take would be a week or 2 weeks or a month of equity markets around the world collapsing. And you could easily see a 20% drop in a month's time across the board. Well, let me take that back. If you see across the board a 20% drop, then you're going to see derivatives affected. Some of them blow up, and it would probably be, a complete disaster. But if you go back to last July or August, I forget when it was, the Japanese market, the Nikkei average was down 25% in 3 days. Now, is that was that deflationary? Yeah, if it persisted, it was. So I think that's exactly what we're going to see is continuing inflation of the things we need, deflation of the things we have, and now they've added another wild card of tariffs. And I don't think people really understand. There's a lot of stuff that we don't make in the United States. And if we tariff them and raise the tariffs higher and raise the tariffs higher, a lot of products are not going to show up. There's going to be shortages of many things that we need.
As silver continues to play a crucial role in modern technology and investment markets, its future looks brighter than ever. Could it truly surpass gold in value? Only time will tell. But the signs increasingly point in that direction. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.